It could be a big week for stocks with more earnings and Fed Chair Powell's speech at Jackson Hole. Let's bring in Keith Lerner, Truist Wealth Co-Chief Investment Officer, to discuss. Let's start with Jackson Hole, because some out there are saying that could be potentially bearish for stocks, especially if Fed Chair Powell indicates to the market something a bit more hawkish than they may like to see. What's your expectation for Jackson Hole? Do you think it will be a sell the news event?
First, great to be with you. To your point, when you look at the Fed funds futures, we're pricing in about an 85% chance of a Fed rate cut in September. So the market wants to see a little bit of an inclination. Listen, I think he's still going to kind of hold things somewhat tight, because we do have two inflation reports, and probably the most important report in my mind is the September 5th employment report, to see if the revisions that we saw were maybe somewhat overdone. But to your point, I think expectations are somewhat high, and you could get a little bit of a setback. But all in all, I don't think that's going to disrupt the underlying trend for the market, which is still higher. What I think could happen is really what you're seeing in like the small caps, the home builders, they're really banking on on that cut. So that's where I think you'll see more of the action.
So if he were to kind of indicate that a 50 basis point cut in September is off the table, maybe something like 25, and then reserve optionality for October and December, how do you think stocks would react to something like that?
I think the market would act well to that. Again, I don't know that he's going to come out and really say that we're going to get the cut. But again, we're looking for a little bit more of a dovish language, a little bit of a hint that the balance between inflation and employment has changed, to let them at least have an insurance cut in September. And I think if he does do that, then maybe you'll see a little bit more of this rotation that we've seen the last few weeks continue. But, big picture, for the S&P 500, I don't think, cuts are crucial necessarily, because think about what's driving that is tech, communications, and they have, more focus on the secular growth story. And the market hasn't seen any rate cuts this year, but the S&P is still up 10%. These other areas of the market are still well below their former highs.
Yeah, I guess those 100 basis points we got last year beginning to feed their way into the system, Keith. We spent a lot of this morning talking about stocks at all-time highs, Q2 earnings essentially crushing it, and then corporate spreads at historic lows going back to the beginning of the century. Is that anywhere near an environment where you would have expected us to talk about rate cuts?
Not historically, it's a fair point. And as you said, valuations are high, credit spreads are really, really well behaved. Now, you can look at that as complacency, or the market, has some confidence in the economy continue to be resilient. Because if you think about the last 5 years, we've gone through a lot of different shocks. We've gone through inflation shocks. We've gone through one of the fastest interest rate cycles or hiking cycles in history. We've gone through the tariffs, and each time these companies have come back more resilient. So I think it's a little bit of both. But I will say that just raises the bar for positive surprises as you go into some of this uncertainty. A lot of talk coming into August about seasonality being weak. So September actually tends to be the weakest month of the year. So I think it may set up for just more of the chop, which has become consensus. But I still think you have to give the underlying bull market trend the benefit of the doubt.
And you say that AI has been a bigger market driver than tariffs, and the One Big Beautiful Bill Act has yet to really filter its way through the market. I'm curious how you square that with some of the cold water that's recently been poured on the AI world, whether it's Sam Altman saying that AI is in a bubble right now, some questions surrounding GPT-5, the questions surrounding the technology that's coming out of China relative to that here in the U.S.?
Sure. Well, there's always risk. And, instead of looking at what people are saying, we're looking at what's actually happening. And what's notable for the technology sector, it has the strongest earnings momentum in the market. And if you look at the relative earnings momentum for tech and communications relative to the rest of the market, it's moving higher. And then going back to the bubble talk, over the last year, the technology sector is up about 27%. On a year-over-year basis, where you really get more of a red light is when you get, 90%, 100% year over year. So we're not seeing that yet. Does that mean that, things are maybe a bit stretched on a short-term basis, that you see some consolidation? No, but our view is every bull market has a key theme. The key dominant theme of this bull market is still AI and technology. And until we see those earning trends actually shift, we would recommend sticking with the underlying positive trend.
So given the chop that you're expecting maybe in the next month or so, you still think the market ends higher in 2025. What are some of the key catalysts that propel it to the upside? Is it some of that fiscal policy, the AI trends that you believe to still be intact?
I think it's a little bit on the technology. The earnings come through again. After this earnings report, maybe we need a bit of a breather. I think the one big beautiful bill is probably somewhat underappreciated. Some of that is front-end loaded, and you're actually seeing cash rates come down somewhat as far as tax rates and some incentives. And I think this is simply some clarity, right? We got the clarity on the tax bill already. We know that we're not going to probably get extreme clarity on tariffs, but at least moving forward and companies being able to look to next year. And we're also expecting a little bit of a bump up in economic growth from about 1.3 this year to about 1.8. So, the underlying trend for the markets, markets tend to follow earnings. As long as the economy moves forward, earnings move forward, markets can move higher, but it's often 2 steps forward, 1 step back. And maybe given where valuations are, it's a little bit slower trajectory to the upside. But we still, as I mentioned, think the earning trends still have some support going forward.
All right.